Start the call. You can start. Am I audible to you?
Yes.
Shall
Shall we start now?
So you are group members of 5 members. 28, right. So you can start. You have 10 minutes for the presentation. So the time management is important. Take on 15. Yeah, 15 minutes for the presentation, 5 minutes for the Q&A session. So you can start your presentations now.
Okay. Good afternoon, everyone. Today we are diving into dynamic financial market. It's a crucial platform for buying and selling of various financial instruments. Global financial market comprise exchange platform for various financial instruments. There are instruments include bonds, currencies, and commodities and derivatives. And when we discuss about the significance of financial market, we can identify about capital flow facilitation, diversity of financial instrument, global interconnection. And when we discuss about the capital flows facilitation, and their core financial market facilitate the flow of capital between entities. There's a combination of business seeking to raise fund through the issuance, and investors looking to allocate their resources efficiency. And we discuss about diversity of financial instruments. The diversity of financial instruments available in the market allowed participants to decide their investment strategies based on risk and potential goals and market conditions. And global interconnection means financial market operates on a global scales. Showcase the interconnection of the economy in the worldwide, and highlights the need of comprehensive understanding of international financial dynamics. And we moving to the next slide. We will discuss about the importance of technologies in financial market. Technology is not just a tool; it's a foundation of efficiency, transparency, and accessibility. And we discussed about the efficiency and speed. Technology has increased efficiency of financial transaction, automated system, and electronic trading platforms. Enables swift reducing processing times and minimizing delays. The efficiency is crucial to handle the large volume of transaction in real time. And when we discuss about the accessibility for all, with the technology advancement, have free access to financial market, online trading platforms, and mobile applications, allow individuals to investigate, participate the market breakdowns and traditional barriers. Break down traditional barriers and provide equal opportunity to everyone to participate in the market. And when we discuss about real-time data analysis, the availability of real-time data analysis tool empower market participants with immediate decisions. Traders, investors, financial professions can make formal decisions based on real-time data available. Then when we discuss about innovation in financial products, technology has facilitated the creation of innovation of financial product, that's service automated investment strategies, development of blockchain technology, and blockchain technology based cryptocurrencies. And market, when we discuss about the market transparency, technology with the technology enhancement, transparency in the financial market by providing real-time information on prices and market conditions. And when we discuss about the historical perspective of financial market, in 1970s, the financial market evaluation is beginning in 1970. That is a pivotal era of financial market, witnessing images of electronic trading revolution of traditional stock market landscape. For example, I have mentioned NSDQ. This is made history as the world's first electronic stock market in 1980s. With the revolution of financial market, program trading via computer algorithm execute trading automatically become popular among the institutional investors and led the portfolio analysis and increase the trading volumes. And when moving to 1990s, revolution and transformation financial market by making them move to accessibility and inclusive through the power of online trading. For example, in 1990s, online brokers allowed individuals to invest their money on stock market based online. And when moving to 2000, it is in 2000 high frequency trading rose prominently. Firm like Citadel and another firm. It is a technology pioneer, fast trading, advanced algorithm transaction market. And when we come into 2010, blockchain and cryptocurrencies, in our journey, 2020 era marked the introduction of blockchain technology and decentralized cryptocurrencies. For example, Bitcoin blockchain technology in 2009. In summary, the milestone collectively shaped the modern financial landscape, and we look forward to anticipate more. And my colleague will take over the discussion further.
Thank you, Infaz. Yeah. Well, in this section, let's discuss the overview of electronic trading platform. So it is a software program which connects the buyers and sellers electronic in financial market, and traders and investors are organize their portfolio digitally and analyze market information and implement orders using applications. An electronic trading platform contains commodities and financial intermediary and financial intermediaries such as brokers, investment banks, stock exchange, market makers, and we can take a product such as stock, bonds, currencies, commodities, and many more. And in next slide, next slide, now we are talking about types of electronic trading platform. First one is an online brokerage platform. It is a brokerage entities provide the web-based portal to regular investors to access the market, like IBM. And the second one is a direct access trading platform. It is offering direct access to the market exchange, and it is a faster trading performance, such as interactive. And third one is a cryptocurrency trading platform. It is offering direct access to market exchange, and it is a faster trading performance. And especially loyal to trading digital assets such as Coinbase and Binance. And another one is forex trading. It is a popular trading platform for foreign exchange and market with providing automated trading and trend analysis. such as MetaTrend. Then when we speak about key features of ETP, and first one is easy to use interface to essential to successful trading. It's want to have a structured design with charts, indicators, and other windows that are simple to use. And second one is strong platform should enable access to a wide range of financial markets, satisfying various demand of investors. And third one is should have to strong security features like encryption and two-factor authorization because of the financial data is very important. And fourth one is assist traders. It is essential make well informed decisions and built-in analyzing tools. And fifth one is traders are able to place orders whenever they want. That's like it's anytime they want orders, they can place. And next slide. Now let's see what are the roles of ETP. And one is accurate and speedily transaction are ensured for real-time trade execution and perfect matching buy and selling orders. And second one is to the facilitation of the transaction between buyers and sellers situated in different areas. Electronic trading platform enhance market literacy. And third one is controlling and reducing the risk and related to their position. Such limit and stop the loss orders. And another one is order execution is speed by automation, accuracy, which also guarantees trading decision stability. Finally, when we speak about the impact of the automation on trading efficiency and liquidity, first one is since algorithms can analyze market data and complete the details in milliseconds, and they can react to these changes in markets such as quickly than human trades. And second one is autonomous trading system have a capacity to manage many transactions at once. And automated system, then another one is automated system enables smooth communication to many trading points. And it is always available, then traders can arrange it is on any time to choose. And it can process the orders across the many locations. This improvement help to stop information leaks and reduce the impact large traders and liquidity. Okay, then now my colleagues Gayan will continue here after with the high frequency trading. Gayan.
Thank you, Udyanga. So here we will talk about the high frequency trading. So what is this actually what is this HFT? So this is HFT is a trading is type of algorithmic trading. So traders are able to use HFT when they analyze important data to make decisions and complicate trade in matters of few seconds. HFT facilitates large volume of traders to do this trading in short amount of time while keeping tracking of market movement and identify arbitrage opportunities. So this is the high frequency trading. But in this high frequency trading, we have few significant areas in HFT. So that there will be the HFTs become a high significant component of the modern financial market. It involves the use of complex algorithms and high-speed computer system to execute trade at extremely rapid speed. So often measured. So then often measured is that microsecond. So here are some key reasons why high frequency trading is significant in modern market. Let's talk about the first. It is speed, because HFT is a very speed. It is very speed. So the speed will be one of the significant component of HFT. The second one will be liquidity provision. So the liquidity provision also this liquidity provision can contribute to lower bid ask, separated and reduce trading costs for all the market participants. So that's why the liquidity provision will be the significant component of the HFT. So third one is arbitrage opportunities. And we'll next move to the fourth one. Fourth one will be the market efficiency. So market efficiency will help to, it will be HFT firms help ensure that asset purchase more accurately and reflect fundamental value. So this is this HFT will be very market efficiency. So that's why the market efficiency will be the significant component of this HFT. So then when we move to last one, it will be the there is some risk also will be there. So HFT has also been subject to criticism of criticize, argue that an HFT can market volunteer, so contribute to flash crashes and create unfair advantages for high frequency trading at the expenses of traditional investor. So additionally, the complexity and complexity will be the complexity of HFT system raise concern about the systematic risk and potential for market disruption. So will we talk about the what are the benefits and concern associated with the HFT regarding HFT for blockchain and cryptocurrency, artificial intelligence and machine learning, and regulatory technology, cybersecurity, and mobile and vintage. So here we have several benefits and several risks also in each line. As example, in blockchain and cryptocurrency, we have the market efficiency will be our one of benefit, and as well as profit opportunities will be our one of benefit. But as same as we have the risks will be there, liquidity and technological risk and regulatory challenges will be the some risk and challenges under blockchain and cryptocurrency. And AI and machine learning also, there will be several benefits and concerns. And as the in blockchain and AI and machine learning, we have same challenges here as the market volatility. And after that, but this all the blockchain, AI, and RegTech, cybersecurity, this every trading platform, we have common benefit, that is speed. So I will move to the I will take over my presentation to my next colleague, to Sumudura, to continue.
Where is disturbing you? Am I audible? I'm disturbing you. Your time is over. How many slides are there? How many slides are there?
9 slides. Yeah.
Five. Now we're moving to the Q&A session. So can you pass the slides just to CV?
Madam, shall we start?
No, your time is over. 15 minutes is over. Now we are moving to the Q&A session. So I want to see what are the other slides that you are planned to the present. So time is over. Time management is important. I have allocated.
Yeah, again, just to move the slide as per the miss instruction, just what we needed to it.
Okay. So we are moving to the Q&A session now. I will invite group number 2. Who are the members? Group number 2. Right, you can raise your hand. You have 5 minutes for the Q&A. Yeah.
How technological advancement due to the evolution of payments, methods, payment systems, and currencies.
Get the question?
Okay, shall I answer?
Can I repeat?
Yes, can you hear me?
Yes.
Yeah, I'll answer. In the technological advancement, make payment systems more smoother than the earlier. They help us to pay faster and safer and more easily. For example, when with the smartphone we can pay with just a tap, and with the things of like cryptocurrencies, we have new ways to buy and sell the things online. So technology helps make money and payment work smoother with better difference.
Any more questions? Another question? Get the question? What are the trends in financial cyber security? What are the trends in technological in cyber security?
Shall I answer the question?
Yes.
Yeah, like when it comes to cybersecurity, this cybersecurity mean in online platform how to keep our money in a safe manner. Like it is introducing of two-factor authentication, biometrics, face recognition. Those things can be considered as an advancement in like emerging trend in cybersecurity.
Right. So I'm asking one question from you, just to check your commitment on the topic. In your presentation, you explained that high frequency trading. You elaborate more on that. High frequency trading. So under that, as a benefit, so what as a impact, you mentioned that this high frequency trading can be affected to the arbitrage opportunity as well as market efficiency. Am I correct? In your presentation, I saw it. Did you hear me? Am I clear at you?
Yes, madam.
Yes, madam.
Under the high frequency trading, as its impact, you mentioned that arbitrage opportunity and market efficiency. I want to know how this high frequency trading impact on the market efficiency. Whether it improve market efficiency or there any impact to the less efficiency. And also when it's come to the arbitrage opportunity with the high frequency trading, whether investors can get the arbitrage opportunity or is it difficult to get the arbitrage opportunity? So that's that I want to clarify from your view.
So as example, madam, for arbitrage opportunities, high frequency trading platforms, high frequency trading firms can simultaneously buy security and on one exchange where price is strictly low. So low and sell it another exchange where it is price is strictly high. So thereby a profit of this price difference in this arbitrage opportunity. But here it is not that much difficult to do it, miss.
So it means that still it is possible to get the arbitrage profit with the high frequency trading.
Yes, madam.
But you better do it with the high frequency trading. So I can accept the answer. But anyway, with the developed market with the high frequency trading, As you mentioned, the trading or the transactions is occurred within very few seconds, right? Large number of transactions can executed within 1 minute. So likewise, high frequency trading by using the technology like this, so market efficiency will increase. So investors, the possibility of getting the arbitrage profit by looking at the inefficiencies is very difficult when we apply technological things to the market. So likewise, anyway, you did a very good presentation. PowerPoint is very structured, but anyway, time management is the problem. So I have allocated 15 minutes. Your Q&A session is also okay. Can you go to the slide number 1? Again, I want to check the registration number in order to check my sheet. Can you go to the slide number 1? Registration, right? So these are your registration, 7, 27, 26, 28, and 20. Right. Good. Thank you very much for your presentation. We appreciate your contribution. Thank you. So you can stop the sharing so we can go to the next. Group number 2.
Thank you, ma'am.
Thank you.
I know you, the allocation of the module, I share the sheet. I management presentation. Time management is important. 5% I have allocated. Right? We have to make the time.
Completely analyze the financial infrastructure and completely study the financial system of Sri Lanka. And development. Financial infrastructure in Sri Lanka. It facilitates digital transactions and risk and monitoring growth. It includes the anticipated managers, regulatory areas, and economic information. The presentation explores the importance of financial infrastructure, the advanced emerging trends, and the story shaping finance, driving Sri Lanka's economic growth. Let's look at the background of Sri Lanka's finance. It consists of 5 components: financial infrastructure, financial development, okay, financial institutions and regulatory authorities. Our group members will discuss about these components in their presentation. It's with the historical information solution of finance. I have divided into 2 periods, that is before 1977 and after 1977. Before 1977, 1950 Central Bank was established. So there were only 10 commercial banks, 14 foreign land branches, and there were few debt financial institutions. There were no aggregate system in both monetary and non-monetary. Because of that, it was a vital function of the central bank to develop a strong financial system to enhance the to achieve the objectives of the developing country. In between 1960 and 1970, government directly interfered in the financial sector, and government established new public sector financial institutions, and the government introduced new legislations and controls on financial sector activities. Then, but the private sector was not allowed to be involved in the financial sector. As a result of that, public sector monopoly was created in that period. Let's look at the after 1977. In after 1977, government introduced new liberalized economic policy. Then finance sector was highly controlled and structured. So government accepted the introduction of more sophisticated financial instruments. Then government decided to make technological improvements to integrate financial market. So the new legislation was amended than existing legislations. Next important thing is financial sector reform program. So the objective was to create the efficient and effective financial system. Then after that, the foreign banks entered the Sri Lanka financial system and developed new foreign banks. Then private banks also permitted to establish new banks. Then private sector allowed to create special financial institutions. So my part is over and I invite questions to come.
So we have a financial system well organized with this thematic various institutions. Various institutions help the individuals and businesses to mobilize saving, allocating credit, and facilitating financial the most important player of this financial system is Central Bank of Sri Lanka. It is the part of the national financial system. The CBSL is established critical responsibilities like formulating and implementing monetary policies to achieve macroeconomic goals like price stability and economic growth, and also regulating and supervising the financial system to ensure the stability and equity. Actually, CBSL has solved.
Excuse me, we cannot see the slides.
During managing Sri Lanka district. Here, for essential resource for external stability. As an example, in 2023, the CBSL increased interest rate of fluctuations. Also, the CBSL intervenes in the foreign exchange market to maintain the stable exchange rates. And also CBSL collaborate with the other institution in the financial system like regulator. The monetary board of the CBSL regulation and election for the financial system. Also banking institution, there are two types of banking institutions, and election specialist bank. The election commercial bank supports a comprehensive range of financial services, including deposit taking, lending, and international trading. Finance, State Bank of Ceylon, People's Bank, and International Bank. And election specialist bank banks started customer segments such as development of investment banking, for example, regional saving bank, non-banking financial institution bank, for segment and relation to finance companies, provide deposit taking, lending, and leasing, and better money transfers. And specialist leasing companies focused on the financial sectors
medical and machinery, and insurance company offers under health insurance and pension and financial retirement saving plan. As an example, in financial inclusion, MIS like cyber development finance, PSC provide financial services underserved population, covering the small businesses and individuals participating in rural areas and number of people.
To continue the presentation, it will be one part to express the financial model under both support financial. Here I have divided market type, market type, central bank of Srilanka, divided as a financial market. The first one is one market and external market. They have divided the actually develop the securities. These two markets they have and then for the further classification they are divided to other parts of the primary market and the secondary market. Primary market are for using the first time issuers. And the second market is the market that use for the trading, data, which will be in the primary market. The another, of course, the market is the market so security trading and the market for the equity trading. The market for the financial and the market for the equity financial. Under Colombo and Colombo stock exchange, represent the 219 companies of the financial market and market capitalization of 4,248.93 million. In these 219 companies, under public companies incorporate under number 7 of 2007 Act, and other secondary of companies are registered under compliance with relevant protocols. Going forward, this is the report market under financial market for stage money market. Money market used for the short-term period. For the liquidity, short-term liquidity level, fulfilling the funding needs, and there are I have mentioned example for trading securities in the money market. That is facilities, replacement facilities, fixed deposit and bank activities. The market is capital market is the market for using the long-term equities. In capital market, issuers are the government, bank and private companies, and primary investors are pension and provident fund and insurance companies. These are some examples of trading in capital market. They are corporate bonds and I will discuss about the financial instruments and products of Sri Lanka. Deposit. There are three types of deposit: demand deposit, saving deposit, and fixed deposit. Demand deposit is to secure the transaction and funds, and also will provide the services such as debt facilities, standing orders, ATM cards, and debit cards for easy withdrawals and payments. And saving deposit and fixed deposit are interest-bearing accounts, and saving accounts, the depositor can withdraw their funds at any time. Deposit, there is a agreed period and agreed interest rate. So, and also depositor can borrow funds using deposit as a collateral. Loan is the financial institution loan offered to a borrower
with the agreed terms of repay, paying back the installment of full and with interest. There are three types of loans. Here I have stated personal loan, home loan, and vehicle loan. Personal loans are unsecured loans and will have pay high interest rates and they can use for any purpose. And home loans and vehicle loans are secured loans with the lower interest rate when you compare with the personal loan. Next one is special bills and bonds. Both are government securities issued by public debt department of central bank on behalf of Sri Lankan government. We can see the open rate face value maturity period in the treasury bill session and also they will issue for 1 year maturity period. And treasury bonds the medium and long term government security transaction, purchasing and sales transaction, electronically recorded in central bank system. We call it as Lanka security system. Next one is repurchase agreement. Involved the sales of government securities for cash agreed terms of repurchasing. And commercial papers are short-term unsecured debt securities issued by private sector companies to banks and financial institutions. Next one is corporate bonds and debentures. These securities are private sector issued by private sector companies. Corporate bonds issued by collateral. They investor can enjoy the interest income and also at the maturity they can take the principal amount. The debentures are unsecured interest-bearing bonds issued by self-institutions and institutions they can go mainly stock Colombo stock exchange and licensed stock brokers, rating agents, and next financial asset-backed security. Bonds are secured by mortgages, loans and receivables covered by institutions. Publicly guaranteed provision. Financial leases including legal owners, they can lending their capital and equipment to the lessee. So the lessee will have to pay interest of the principal amount. Lessee have the right of use of capital. Thank you. If control connectivity, the government is able to payment are the key examples. So, digital banking website. There is a and that is that we have internet financial system and it is quite in case of that is paying banking including banking, shorting money, and legal part. So internet banking and platform. And here I mentioned that interface and integration compared to the global for these countries, we are in the initial stage to develop. Next one is AI and infrastructure. When we talk about the infrastructure, we are currently at the initial stage of investment adoption. For sure, we need to focus on physical functionality, regular report, and data integration for the market. When we talk about the financial equation and laptop for example. Here is the discuss our recommendation. The goal is finance literacy program. As an example, trying to get to education, the public people demonstrate features and possible steps such as report and scam.
How many slides are there? Number 3. Two again. Investigation from your friends. The finally story to tell. Last question. What are the challenges of identity in financial technology?
We can go there in fintech technology also. In Sri Lanka, we are like basic country is taking compared with the foreign country. We are technology and also we have faced many issues when we are adopting the technology as coverage of network coverage. There are some areas there is not free coverage, so there's challenge with anything system and technology for that kind of the people who live in that area. And also when it comes to the financial things, investment will have like will take high cost, so people need to investment and the institute does not have high. So we need for that technology equipment and also legislation also there are some for the security things also they need to be developed. So in implementing time to time the rules and legal things will completed by government. So these are the challenges.
Yes.
Then is the second of Srilanka for the trading and to buy and market so the Venice and has been established in 1985 after in operate after and there are 219% the capitalization of market capitalization of without
It is used to take as a platform for sale and purchase gas for that company.
it's electronic
Yes. Yes. For the Colombo Stock Exchange, what is the electronic platform or the technology or the infrastructure for the trading? What is that? It's all automated trading system. ATA. Anything else? I have any more questions? No. That's all. Are you satisfied? And what is time? This is financial infrastructure. And anyone from the team can define what is financial infrastructure.
As a country, there are transactions with cash and electronic cash. Yeah. So based on that transaction, there should be some additional fee, additional help with the process, so we can follow the more financial perspective, and also there is a legal platform if it works and we execute website collaboration, legal thing, audit.
It is like, like financial system of Sri Lanka. I think it is next one. Go to the next one. Yes, control of the financial system, financial infrastructure. So actually, your topic is related to that. Your focus on that. Financial infrastructure means technological things or the, I think, defining very well system, networks, that support to the financial transaction. So what is the ultimate objective of financial system? What is the aim of a financial system? What is the ultimate objective of financial system? Growth is okay, but anyway, what is the, normally when we say the financial system, yes? No. What is the objective of financial system? Anyone from the audience? What is the objective of financial system of a country? Huh? Yes. Generating or intermediation. Intermediation. What is the intermediation? Transferring funds from surplus units to deficit units. All these components in the financial system facilitate into that. So even the infrastructure, I think I didn't see anything related to the real-time gross settlement system, Lanka here, online payment system, interbank system, check clearing system. I didn't see anything in your slides related to that infrastructure of the financial system of Sri Lanka. So that is your focus in your presentation. That part is left. Right. My question, when it's come to the Sri Lanka financial system, not related to the technological thing, what is the major challenge? When you look at the Sri Lankan financial system, what is the main challenge? I think it was there in your slides also. What is the main challenge in Sri Lanka when it's come to the Sri Lankan financial system? Lack of knowledge, yes. We can use the term like financial inclusion. I think it was their financial inclusion. So general public or the people in the village or the financial literacy level is very low. So in order to enhance that part, there are certain strategies like establishing microfinance companies, going to the village bank, things like that, certain things are there. So that is the major challenge. I saw it in the financial inclusion in the slides. In addition to that, second one is non-profit loan. Overtaking of the norms. Overtaken. So these are the two challenges. So my main concern is your focus on the financial infrastructure part is very low. That part is not focused well. So you are talking about the technology and the things, financial market, then capital market, money market, instruments, that kind of thing. But anyway, your title is analyzing the financial infrastructure. Comprehensive study about the financial system. So related to the financial system, what are the infrastructure? So if you go to the central bank website, I think you can see these are the systems, these are the infrastructure. Real-time settlement system, Lanka here, so like this. So that part is like that. But anyway, good presentation you have prepared. You have committed a lot. You might have learned something. Have you get something from when you are preparing for this presentation? Did you learn something? And so, for the next presentation, you can Okay, Chatur, your group members, I think registration number 5, 8, 15, 17, 22. And why it takes at the start it makes access to computer and certification and brand value. And it comes from the reputation and actually participate in engagement. And these are the examples for prospective as the target prospective has implemented projects to reduce carbon and the potential ban the ban scheme financial stability, the financial encouragement support and environment friendly projects such as renewable energy productions and energy efficient buildings, sustainable agriculture activities, and the nation trust bank, the ban offers a loan and we facility and financial options. Investing in renewable energy and energy efficiency and conversion effects, and PSC has implemented ideas to reduce the environmental impact, conserve natural resources, and enhance social welfare. And these are the understand ESG factors, the environment factors, access capabilities, impact on natural resources, ecosystem, the social factors, impact on the society. For employees, communities, and customers and other stakeholders. So, governance factors focus on the sometimes interact across leadership and structure and the adherence to ethical standards. Stage of sustainable finance. In 19%. The second stage is the advanced challenges. It's in 99. The stage is the 21st century engineering. Initially, there are only focus areas. First one is the size of industry. India is the address the power and step up is sustainable. The one is the financial crisis in 2008. This crisis exposed the dangers of thinking on the short term and encourage to investment. The third one is the financial to appear the way investors environmental technical project. The one is the Paris Agreement sustainability goals. The commitments that climate changes and achieve sustainability. Fourth stage is sustainable finance. We are seeing what how is considered investment which prioritize sugar positive social and environment outcome. Second one is evolving regulation. Government are creating new policies and guidelines to empower the sustainable finance and investment. Third one is mainstreaming sustainability. Yeah, sustainable finance is no longer a mixed area, but it becoming that's all now I'm there are two strong considers of milestone in integrating ESG consideration. This one is launch of event principles for responsible investment. That means that there are a set of 6 principles that encourage investors to incorporate ESG factors into their investment decisions and ownership practices. So then is the rates of ESG deterioration in 2000s and why the PRI was significant switch. The board has moved to integrating ESG throughout 2000 in other strong consider. So let's see what is the current landscape of global sustainable finance. It means stakeholders in the financial ecosystem acknowledge the need to integrate sustainability into strategy and operation. As well as regulatory changes, investor preferences and heightened awareness of climate change's impacts drive the evolution of sustainable finance. Other one is the global landscape of sustainable finance is dynamic, reflecting ongoing shifts and developments. Recognition of sustainability is significantly growing across financial sectors, highlighting the importance of long-term validity and responsible investing. So let's see what is the overview of the current state of sustainable finance. This one is growing movement. So it means sustainable finance has gained significant movement globally. Other one is regulatory support. That means the government and regulatory bodies worldwide are increasingly recognizing the importance of sustainable finance. Fourth one is the main theme, raise of green and social bonds. Green bonds means they are refunding and funding the green projects. Social bonds is it's a partnership that they are going to take and they are given they aim the citizens in that place and they are giving the funding for the day. That's the meaning of social bonds. So green bonds and social bonds have become popular instruments for raising capital for environmental and social beneficial projects. Fourth one is ESG integration in investment practices. Investors and asset managers are integrating ESG factors into their decision-making process. So let's see what key players in institution driving sustainable investment. First one is United Nations. It's for responsible investment. That's what we call PRI. Second is International Finance Corporation, IFSC. Third one is Green Climate Fund. That's here. TCF, Sustainable Investment Funds and Asset Managers, European Investment Bank, EIB, Development Finance Institution, DFIs, rating agencies, and ESG data providers. So that's all the state of my part. I'll have the presentation to Satish. Customers, community, standardized data and it's subjective access of diversity and scholarship regularity and uncertainty. ESP is ESP loss by letting changing. They will definitely continuously take up with these changes. They will be open and transparent. And if they it was any content concept. Support sustainability and make sure it brings it out of their planning in many extent vision of the progress. Transportation and as like reducing pollution, reducing resources wasted. It's kind of a social consideration, which is consideration is the balance between goals and technology. The third one is governance consideration, which is industry free company governance, such as finance and telecommunication. And equity involved. And she effectively understood the future trends and here we are elected three main future trends, which we put on is climate finance meeting, which is debating against climate change here for sustainable finance. The financial social impact university is which is we see especially trees to generate positive functional outcomes that receive such as healthcare, education, and income. Big background is technology driven, but generations, functions, finance, and telecommunications. And yes, before practices research integration, the investment and maybe consider factors to become internal traditional financial analysis. Economic trade holders engagement and important mechanism stakeholders engagement and transparent reporting practices. The third one is the most important example between the framework and standards. Governments and regulatory bodies may play a more active role in sustainable finance. So this is also here, which is sustainable finance undergoing an impact investigation, gain from disadvantages, standardized reporting and transportation excellence. So likewise, to navigate effectively the sustainability. So we get together to make the sustainable finance create a better. So this is the end of the presentation. Is all for this is for this presentation. Exactly. Very much. Thank you. Number 4.
What is the significance of the incorporating ESP factor global event?
Incorporation of ESP global investors are from their sustainability to get the value creation, and it helps to identify their risk and opportunities as well. That's another main thing in ESP.
What challenges do investors face when they are integrating ESP factors into their investment?
redefining location and changing. So investors are a situation like this. Suppose the correlate and how to explain. Now we are topic is sustainable finance and ESG factors. So what is the relationship between sustainable finance and ESG? What is the relationship? How the positive relationship? Because nowadays the trending if as an example, if a company is going with the ESG factors, they are making decisions based on that factors. So their investment is also going to increase because the increase their social factor, the social what is the thinking they are using these kind of things as because most of the things are going green way now. Therefore, the main thing is going with the ESG factors are help for the investments and for their investments. Now, in your presentation, you mentioned that you make green bonds as a strategy for the sustainable finance. So, can you explain the difference between normal corporate bonds and the green bonds? Normal corporate bonds are the normal investments they are doing. That means normal investment means normally what they are doing is the normal investment. Green bonds means that they are thinking means that as an example for the ethical way to waste management. That is the green bond. That we are calling for that green bond management. For that they are finding for the green bonds. Do you want more elaboration? Green bonds also issued by company. Normal corporate bonds also issued by company. So both are issuing for finance to raise the funds to take the long-term capital. So you explained it, but it's not clear. Anyone from the team? Green bond, yes. Environment, risk management, renewable energy, natural layers. So likewise, that's the thing. So by issuing green bonds, you are raising funds for the environmental friendly project, for the environmental friendly investment. So these are from the company perspective. If I ask my last question, suppose as an investor, I'm a street investor. Street investor in social responsible investment. So how I construct my portfolio? Now you are issuing bonds like this that is affecting to the environment, pollution, waste management, ESG factors. So likewise, so as an investor, how I contribute, or how I take this ESG strategy, so ESG matters to my portfolio. What is the way? Yeah, by investing in social bonds. By selecting the bonds that companies issuing for the raising capital for the green projects, giving protections like waste management, so likewise. So that way, I should construct my portfolio using the bonds, using the securities and investments, considering that aspect. So then I can be a social responsible investor. Okay. number 3. What is it? Group number 3, that procedure to our registration number 3, 2, 3, 4, 12, 23. We would like to talk about the impact of geopolitical events on global. This is our statement. This is our table of contents. And with that said, we are talking about what is the geopolitical events. Geopolitical events refer to significant events for development that involve interaction between political entities, typically on a global or regional scale. These events are shaped by the complexity of geography, politics, economic, and other power dynamics among nations and international factors. These are the most common geopolitical events: territorial dispute, conflicts, diplomatic relations, trade agreements, economic situation, exercise of military power. In that slide, we are moving to the how the geopolitical events relevant to financial markets. Geopolitical events we have several impacts on financial markets. When thinking about the market sentiment decisions, there is a positive and negative events. Positive events such as fees and rebates, favorable trade agreements can boost or influence investors in investment decisions, and negative events such as conflicts, political uncertainty can affect the fear and uncertainty about the investment in financial markets. Finally, that causes to the sale of financial assets in the markets. When thinking about the risk perception, investors analyze geopolitical risk to mitigate their investment risk, and how they are mitigating. They can diversify their investment in safe haven assets like gold, government bonds, and also they are investing currency US dollars. And also thinking about currency markets, geopolitical events can impact the increase of the exchange rate. The exchange rate directly affected to the companies, important export costs, and also geopolitical events can impact the commodity prices, interest rate, global trade and supply chains, policy responses. And this is all about my part. I would like to invite Madhush to continue our presentation.
My major geopolitical event has been example to the geopolitical events. Firstly, attack of 2001 USA attack globally in Pentagon. That what led to the terrorism attack to the globally. After that, Colombo is the USA and Soviet Russian back to the globally. After that, falling off early. That means German impacts for the and mainly the rise of China. That means recently China economic growth and military growth in China that mainly impact to the world. That's been unbalance of poverty impact for the China growth. Also, the recently impact is COVID-19 pandemic situation, and also it's the recent part, recently situation that graphically that was the impact of China economies to the COVID-19 pandemic situation, they gradually left downgrade, and after that 2019 and 20, the impact of the Thai economics, and also the geopolitical impact for the investors in the world economy. That's the impact of the geopolitical downgrade, and also the geopolitical effects to the worldwide that will impact international relations, long-lasting constituents, uncertain outcomes, and our dynamic. Let's move into the historical context of significance geopolitical occurrence. That means understand the historical context. Significant geopolitical occurrence is crucial for the community to inform the perspective of our current events. Yes, why? Recurring patterns. That means geopolitical issues like Israel, Palestine conflict, Colombo, historical events sharply current complex continues and changes historical context sharply. Geopolitical toward world legacy and present like Russia, and the last one is identifying underlying historical claims and strategic significant aids compending complexes ongoing South China by handles.
Thank you, Mr. I'm going to discuss about the key geopolitical factors affecting the financial market. We have identified four main geopolitical factors: political instability, market tension, military conflict, and economic sanction. These four factors are directly and indirectly affecting the global financial market. Political instability, because of the political instability, economic growth will be a minus, and there is a negative relationship between geopolitical instability and financial market sustainability. Then also investors become uncertain about the future economic and regulatory environment. Then because of the trade tensions, it makes a doubt about future trade policies and regulation. So it leads to increased volatility in financial market, and it leads to currency fluctuation as investors to the perceived risk associated with the dispute. Then because of the military conflict, investors often become risk averse. So investors shifting their holdings from risky assets to safer assets such as gold, government. Likewise, then also government frequency rise, defense spending, and taxes increases. So budget deficit. Then because of the economic tension, they are reducing trade and investment flows with other regions. And it decreasing foreign exchange inflows and capital flights, and in global shortage and prices increase for business and consumer life. My part is over. I would like to thank you.
We would like to talk about the role of government committees in the taking crucial role in the responsible geopolitical development and determining economic outcome. I would like to talk about the government on to the geopolitical events. There are tables you can see, right? First one is geopolitical events, the second one is the government reaction, and third one is the ultimate slope. War, conflict, and trade dispute we can take as the geopolitical events. Trade policy, diplomatic measures, and economic engagement we can take as a geopolitical reaction. Using this method, government ultimately goal is to protect national interests and address the security issue. So, next slide. Central bank interventions and monetary policy activity. Monetary policy is the central bank control over the money supply and costing the economy and aiming to achieve microeconomics price stability. High inflation in the three duties in the central bank in this slide. First one is the policy interest rate. Second one is the control economic liquidity. Third one is the conduct foreign market operation to achieve inflation. Next slide, mention two concepts called stability, price stability, and monetary policy framework. Price stability sustainable economic growth by preventing distorted economic decision and maintain low real inflation level. Maintenance central banks use average weighted core monetary rate. It aims for implementing enhanced monetary policy, including flexible inflation targeting and monetary targeting to maintain growth momentum and stabilize inflation. Depending on the monetary policy framework, for that central bank use FIT framework. It helps to stimulate economic growth and maintain 5% target over the medium term. For that, average weighted for monetary rate serve as the open target and create short-term investment is finally establish inflation and maintain growth momentum. That's it.
I will continue the presentation on the subtopic called long-term effect and recovery of global finance market. So that we consider global financial crisis that may happen due to the world war and natural disaster, other things, pandemic situation like COVID-19. Those are the impact on the global finance crisis. When we come to the implication of effects on the global finance market, declining confidence and GDP growth, investment and expenditure, other things, share market decline may be linked to the other economic climates, rising oil price, inflation highs, also potential interest rate rise. Those are the impact on all the global finance market crisis situation. When we move to the next slide, same impact on the implication of investor like that, long-term impact that creates declining confidence of growth. All the other financial market reactions, share market and currency depreciation, all the factors impact on investment decision. So that impact on lots of impacts on opportunities country likewise. Also, when we consider the recovery of geographical event on global finance market, all the reference countries approach commonly for same challenges in global crisis for mitigating their risk on global finance crisis. First point is financial market integration. That integration increase their liquidity and competitiveness in the market, and including liquidity, competitiveness and transparency, saving, investment option, risk management like that. All are the impact of better control of saving option and effective of the financial market activity. And next point, accounting harmonization. It is challenging to gather information cross-border countries due to there is a different type of accounting system, so that it is mitigating that this harmonization used by the countries for minimize their accounting system deficiencies and to control maximum of use there. And next point, efficient risk management. All the countries face this challenge to use their risk mitigation option to face the challenge well. So that in our countries, also Sri Lanka is using CBSL policy and regulation to mitigate those effects. Those are the final aspects of my presentation. Move to the
Thank you. So now let's talk about what are the potential geopolitical events are. So as you can see here, there are small conflicts and US and China Cold War and cyber attack. Let's discuss in detail what are those. So from war conflicts, as you know about the Russia, Ukraine and the Hamas war, there are so many effects that we can identify in future what they can affect to the financial markets. So it could be mainly impact to the global growth, and also oil and gas prices can be high, and also inflation also can be affected, as we can experience that now also. And also from mainly the US as a worldwide, the main country that operates global markets and the other events. So now there's a significant potential that we can identify that Trump is going to be the next president. So from that we can expect the dollar can be boosted again and treasury can be moved to higher, and markets also there can be a lot of tax implications, and also from cyber attacks, which also we can identify several incidents. It can be affected the financial systems and their credit and liquidity flows, and also North Korea nuclear events also can be affected a lot. And also, what are the strategies that we can discuss mitigate these issues? So we can stay informed about these scenarios, that we can get ready for the decisions and scenario planning and sensitivity, diversification and effective risk management, contingency planning, financial flexibility and liquidity management, digitalization and communication strategy. So when we come to the conclusion, from the beginning, we talk about what are the geopolitical events are, and also what are the key factors affecting the financial markets, and also what are the Sri Lankan government policies and their interventions about this scenario, and also what are the future outlooks. And also with all of that, as investors, we should be able to know about these incidents and get to ready for the decision making, because higher the risk, higher the return. That's what investors should be more. So this is our results. Thank you very much.
Thanks, Anish. Anyway, the presentation was considered. What the percentages we have to prepare again? All are good. I know.
How can investors protect themselves from geopolitical risk? They can their investment. They can invest safe haven assets like gold, government bonds, and money like US dollars to mitigate their risk, and also get to the contracts like hedge contracts, futures and options contracts. And if they can enter futures and option contracts, they can mitigate their risk.
Are there any resources you use to stay informed about geopolitical events that might affect the market?
As I explained here, I think you always stay informed about what are the events happening in the global financial market. So then investors can be ready to take what are the decisions that can take to minimize the risk. So there are several tools that we can use. Like there are so many investor forums. And there's a channel called Bloomberg. You can take to that and see a decision. Reuters, Thomson Reuters, Forex market, you can analyze that also. So there are so many key tools that we can be able to stay informed about the market. Right. I have more.
Sri Lanka is a geopolitically important country.
It's because the recent scenario about the Colombo incident, so Sri Lanka has significantly affected the world market, because there are so many countries keep an eye on Sri Lanka incidents, because it's kind of a geographically, Sri Lanka is very the country that is really affected, because right now we incorporate China and India, they are trying to use our area. So there are like, you see Sri Lanka, other countries have some kind of things, so it can affect the global markets. Yeah, you mentioned that for city that because of this and also the natural because of this, we are geopolitically very important country. So what are the things like? Who is the main country concerned on our? I mean, you can mention three at least. Who are the main parties from the countries looking at Sri Lanka always? China, India,
What is the question? They are always looking at what is happening in there and they are trying to get something from here because they know that we are in a particularly very important country. Next question. Do you think that happening kind of things like geopolitical events, is it a good thing or bad thing? How it's impact? As a suppose that as an investor in Sri Lanka, so how it affected to the portfolio investment or whatever? If you have a portfolio in other countries, so do you think is it a good thing? Is it a bad thing?
So when it comes to investor aspects, they can take it as an advantage always, whether it is bad or good, because that's the way that they can mitigate the risk and how to apply the scenarios like when they investing.
Like depends on it. Depends.
Yeah, that's it.
Right. So did you see the word when this kind of an event, geopolitical things are happening in a country, in financial management or in finance, there's a special terms or special techniques we are using to measure the impact of this geopolitical event to our market, our cash flow, our investment, our credit flow. So like this, we are using that thing in the research. They are using this what we call this term. We are measuring some impact of geopolitical events like war or whatever. So what is the term then?
The US dollar.
No, I'm asking theoretical term. When happened in the geopolitical thing, so what when happened in some incident in the one country, so it impact to other country also, even Sri Lanka, other country. So this impact we are measuring theoretically, we are using a term for that. You look at the empirical things, I think you for sure you will see that. So what is the term? Spillover effect. In which that media occurrence in the things related to spillover effect. No. Volatility and spillover effect. So that is actually if you are doing a research, if you want to analyze the impact of certain event to our country, so that is the conceptual things. That is actually there are strategies you can apply, event strategy kind of things are there. So but the term or the theoretical conceptual term we are using is the volatility and spillover effect of this particular event. That is if you look at the empirical CVC, but anyway it's a good percentage, it's very factful. And you are very confident about this that we learn. That's something. Where did you get something to your knowledge? Right. That's right.
Good afternoon, everyone. Today our main topic is rainfall. So this is our team. We're talking about the overview of rainfall. Rainfall are the income securities that finance projects which have the environment which have the impact on the environment and the climate. So green bonds are commonly used for energy efficiency projects, renewable energy projects, population control projects, and clean transportation projects and green building projects also. When we talking about the background, the main difference between green bond and the commercial corporate debenture, it is the how the proceeds from the bond use. So a green bond is no different from the other corporate debenture. The difference is for the purpose which the it is used. These are the benefits of issuing green bonds. Improve the investor diversification, enhance the issuer's reputation, provide an additional sort of sustainable financing, increase alignment regarding the durability of instruments, attract strong investor demand, and it can facilitate the establishment of public-private partnerships. When we're talking about benefits of issuing green bonds for investors, number one is comparable financial returns with the additional of environment and social benefits and contribute to national climate adaptation, enable direct investment in the cleaning of brown sectors and infrastructure activities. This is the historical development of and issuers. In 2008, the World Bank issued its first green bond, and today more than 50 countries have issued green bonds. In Sri Lanka, we are issued the first green bond in 2022. This is the year-wise and country-wise historical development of green bonds. And I will show the presentation to Ashin.
I think you all already have an understanding of what is the so I will talk about the key first and different criteria and identification. And third one is the criteria of green bond as a green. So the key principles of green bond is to build a guideline that promote transparency, disclose, and integrity in the green bond market. And there is established in 2014 by green bond market from International Capital Marketing Association. There are three components of investment principles. I will give a little bit of introduction here. So it's normally here also bodies of projects by green project. First, evaluation and selection. Their evaluation by eligible green project. Management of projects is sure it's green project. Evaluating and their managed green bond projects. Reporting. Providing the financial reporting, environmental impact of financial report, green bond. Verification is to enhance transparency in verification. And I will show the different types criteria of the green bond. These are the main scope and the specification of the green bond. The mainly used by green bond principles and CIC are different opinion. That's mean Center for International Climate and Environmental Research. There are criteria for classifying green bond green. There are some common criteria included here under criteria. Environmental benefit, improvement, continuous improvement, international standard, and verification and certification. It's all my part. I intend to invite two plus people. There are several types of green bond available in Sri Lanka. Unique structure and purpose. Finance and friendly projects. Here are some most common ones. Green loans, green slums bonds. This one is green loans. There are some similarities. Used to finance environmental friendly projects similar to traditional loans. Can offer fixed or variable interest rates, subject to specific green criteria and supporting requirements. There are some differences. The loan using funds involve financing green projects such as renewable energy, clean transportation, sustainable waste management, and green activities. Some financial institutions based on interest-based other incentives. Example, extend repayment periods to encourage green investment. Borrowers typically needs to submit regular reports showing how the loan projects are used and the project's environmental impact. The second one is green. There are some similarities. Used to finance environment friendly projects. Offer fixed or variable interest rates, subject to specific green criteria and reporting requirements. There are some differences. Here fixed income insurance. That's 6% ownership of an underlying asset. Can be structured in various ways, such as leasing, trust, and partnership. The third one is Islamic bonds. There are some similarities. Financial environment friendly projects offer fixed and variable returns. There are some differences. When Islamic bonds are similar to green chips, but have different underlying structures. Ensure purchase and occupancy asset using investor funds and then present to the project developer at the market profit. This profit is then distributed to investors. Example, solar panels. Investment could finance the manufacturing eco-friendly equipment or building materials. My part is over. And we research the global standard under the green card. The one is international capital market participation 1910. It is called the established on the principle of green bonds, and also it is used to the encourage green bonds in the global market, global finance market, and the second one is private one of it. CBI. It also the publishing under the certification of the standard computer request. That is also included in the primary salary that is also covered markers. And as we look at what are the regional recognition under the frameworks that are secretaries and executive of Sri Lanka is responsible for the overseeing the environment project, and also Central Bank of Sri Lanka secretaries it also to the mitigating the and also national environmental legislation and also taxes. The government is ready the tax rates and the tax credits and and also market initiatives and collaboration also finance transport companies and the collaborations organizations they also are and they use environment and project finance and this was a very important to farmers. Sri Lanka is the constitution was next year and this is very important to farmers. They are mainly political transparency and affordability of the reporting to the government with reports. I invited to financial greenwashing means some companies pretending they are friendly and to people and make more money. It's like pay your the car right and saying it's second one is data availability and impact measurement. It's very tricky to get more information and measure impact on greenwashing funded projects and limited solidarity and issuance means corporate sector is significantly increasing their issuing green bonds, but government involvement is very less. Then liquidity concerns means green bond market is still relatively young compared to the traditional market. Despite challenges, there are several opportunities that make green bonds better. Growing investor demand. Some investors, the trend is driven by both environment considerations and potential attractive returns. Also, technical advancement. Blockchain is a new technology that we can exactly see where our money goes, and it's improving transparency and traceability. Green bond issuers, then policy support means government around the world increasingly recognize laws of green bonds and suggest they are improving green bond subsidies and tax rates. It's help to boost market growth and expansion into new sectors. Previously, they focus on renewable energy, and this they are working on sustainable agriculture industry to expand as a new sector. My part is over and
I like to use the recent trends in the green bonds. Green bonds have significantly spread in the Europe country in 2017 from $750 in green bond issuing in Europe. Recent global green bond issuers are public sector and the private sector. In 2020, dominant is public sector issuers, and 2022 private sector. Key market players are the green bond issuers are HSBC, Paris, and Citigroup. Recent development green bond market in May 2019. Background Neutral Science Corporation announced a joint venture collaboration with the US State Group to build a new 65 million commercial manufacturing plant, PN canola in boarding in Western Canada. In Europe, 37.3% of global market share was accounted in Europe in 2022. Policy recommendations for green bonds are standard the green bonds market, adopt high standard of disclosure and reporting, develop scientific with other sectors and instruments, facilitate investment in emerging economy, and promote awareness of green bonds among the potential issuers like associations and green bond issuers. Finally, our conclusion is to there are many critical green bond represent a critical turning point in adoption of financial market in the world, and especially in developing nations where acceptance of green financing may be slower. Policymakers can encourage the issuing of green bonds by implementing supporting measures, including tax breaks, subsidies, and guarantees. And for long-term sustainability and market development, it is essential to foster green institutional investors and increase the circulation of green assets and promote product innovation. Finally, in conclusion, there is a great deal of potential for the green bond market to raise money for environment-friendly initiative and also to shift to low carbon economy is the main conclusion of the green bond issuing market. This is our presentation. Thanks for listening our presentation.
Number 6, the corporation.
What role does tax incentive really encourage sustainable investors in Sri Lanka?
They provided the tax rules and they are providing the tax creditors and exemptions for the encourage for the 20%.
How does the person investor want to be green finance market in Sri Lanka?
It will to expand the financial market, and investors are attractive, and it will to bring more environmental friendly projects.
Thank you for your presentation. Asking of some questions for data in the previous presentation. That's good. I'm asking one question. Compared to conventional type bonds, investor who is investing on the green bonds, what you can say about the risk or rate of return? I'm asking when investor investing on the green bonds compared to the conventional type bonds. What do you feel about the investor required rate of return? Is it higher than normal conventional investments, conventional bond investment, or is it lower than that?
Normal venture. Interest, but to attract the green bond, they should pay more than that.
Any other explanation? You answer according to the research and the empirical studies, feel that is unclear. Yes, that is investors required of return investing on the bond, green bonds compared to conventional investment. Conventional bond investment is it's high. The reason is basically, as the researchers and the scholars are discussing, that is because of that green bonds are issuance normally for a long period than the conventional bonds, because they are for the renewable projects, long-term environmental related projects. So that is going for a lot than the conventional bond. So because of that, you know that with the climate economy larger, with the climate is going that much over or larger, risk is high. So that investors required of return compared to that one is high. So therefore, when the company is issuing green bonds, they have to give some extra premium waiver to the investors to get the attract for that particular. The reason is that is still researchable area. But anyway, you are on this side. Okay. Good presentation again. Thank you for your preparation and the commitment. Last one.
Good evening, everyone. We are going to present today the innovative round of finance managers in the digital here is our different brush. Firstly, look at the what are we are going to present. And our presentation will outline. This is the outline of our presentation. First introduction, then visual finance management. Technical advanced achieving finance, then challenges, then regulatory activity, then training solutions, finance management. In introduction, we divided our topic is three components. What is the Delta, what is the digital era, digital era depends on the industry, role of finance management. We can say there is the evolution of it's the growth of information technology, and which then there is the technology that we could college now within the economy and study. More benefits are there in this information, communication, and legal education. This is the impact of various industries. Yes, mostly are in the finance and banking industry. Finance more efficiency and more effective finance and banking industry. For example, you can highlight digital transaction and inclusion. Then we can see what are the total finance management data. Now finance management represents for many social system. For example, big data analysis and its application in finance decision making and executing artificial intelligence. And this is but they usually we are doing for by digital way. It is the time made it manual. More paperwork and more unefficient. This digital era help us to finance management. Their vision is therapy and product faster report and ensure visibility and for at lower cost. And this information starts with the advanced computer. I will carry out my presentation now.
Data analysis and analytical about the decision making and So how big data analysis and duty forecasting in finance, there are three ways. First one is enhanced revenue generation, proactive risk reduction, enhanced financial flow reduction. So first one, the revenue generation, apart from the operation of the revenue, the big data opens to the door to the economic growth and enabling factors. Second one, risk reduction. It's quickly in the face of stress by tracking and analyzing the data in real time. Third one, in the financial fraud reduction. Throughout the good potential fraud and the reduction of questionable transaction conducted. Next one is machine learning. So usually machine learning is the predictive quality. Machine learning how computer algorithm trained to the real data set before machine learning. In machine learning, the point when they implementing machine learning into the financial forecasting, if the predict supply demand inventory for the market to improve business finance, how we create a value, let's say, forecasted trade budget and several other economic indicators that the business influence performance. Usually the trending machine learning is NLP. So forecasting processing using NLP is based the NLP network training testing generate. These are the currently available technologies. Microsoft, Google Cloud, IBM service. Next one is AI. How to use AI in financial forecast? So AI is now common payment now we use to in practical life. In the financial forecasting, AI also open data, advanced data analysis, and prediction model, real-time data and dynamic forecasting, continuous training and improvement. So let's talk about the data. It's a forecasting and comprehensive scenario analysis. Next one, data analysis. No valuable insights are over. Prediction model is it's a customized prediction model tailored in their specific business. We can use it for AI. Next, real-time and dynamic forecasting, proactive decision based on the most up-to-date information available. Continuous training and improvement is the model and focus accuracy improvement and readable insight. Thank you, Gautam. Let's look at how the challenges faced by financial managers in adapting to the digital year. So, the emerging challenges we can identify the mainly technological advancement. Also, we can see regulatory changes, global economic uncertainty, also market liquidity and emerging market threats. So, the main one is technological advancement. So, when we look how it affects the managers, finance managers should keep pace with the increasing rapid advancements in technology such as cloud-based accounting software, automation and artificial intelligence and data analytics. Also, data management and security. Finance managers struggle to manage a large number of data volume effectively, ensuring the security and privacy of financial data amidst cyber threats and breaches is a significant concern nowadays. Emerging market trends such as cryptocurrency, adoption of blockchain. So now most people are using cryptocurrency and businesses are identifying ways how they can use cryptocurrency when doing business activities. So it is also a new emerging market trend. So let's look at the strategies for overcoming resistance to digital transformation by financial managers. So they can get feedback from their employees and working staff, avoid tackling everything at once, focus on communication, partnering with technological experts. So when we look how we obtain feedback, the regular follow-ups during a digital implementation keeps everyone connected and informed. So if the company is implementing a digital connection process, they must keep on following and get feedback so they will be able to outcome any issues. Finance managers must give employees the chance to discuss setbacks, actioning to feedback. So the finance manager must be in touch with the employee. Avoid tackling everything at once means that they should have strategies and they should be able to decide the aspects of the company should receive the first digital attention. So they must not try to implement all at once. They should identify which is better and take the best strategy.
Partnering with technological experts is the main one that financial managers should do. Collaborating with technological vendors, consultants, and industry experts to leverage best practices and innovative solutions. Partnering with technical experts provides access to specialized knowledge and resources. Focus on communication. The manager should be open to communication in the workplace so he can overcome fear. It's important to be open to have discussions rather than avoiding them. So finance managers leverage distress finance to facilitate digital transformation by allocating resources for technology adoption, training, and infrastructure. It's all from the
Thank you, Asif. This is the overview of digital finance regulation. The rapid evolution of digital finance has got regulatory initiatives worldwide to address the challenges and opportunities by this dynamic landscape. Here I have categorized the overview into main fields continuing. Let's look at the transformation of digital finance. This is the technological advancement in the global connectivity. Next, the key components of digital finance regulations. Under key components, the licensing and authorization means only qualified and relevant players participate in the market. Next, the anti-money laundering, AML, and KYC, known new customers. These are the key systems. Next, the comprehensive data privacy regulations and the facilitates use of cross-border transactions. Next, under evolving regulatory trends in the digital era, regulatory debt process and the open banking, central bank, digital currency. Next, challenges. As financial services become increasingly digitalized, the compliance becomes complex and dynamic area of financial management. We also have categorized challenges into main two categories. This is the rapid technological advancement. Under rapid technological advancement, adapting to technological changes and the data security priority. Next, there are risk management and compliance integrations. There are site security specifications and strategic compliance plans. Next, the regulatory complexity, global regulatory landscape, and the digital finance specific regulations. Next, the talent and skill shortage, lack of digital literacy and trainings, and then industry-wide collaboration. Next, strategies, developing techniques that work to overcome those obstacles is essential to maintaining regulatory compliance while adapting digital advancements. Here, I have mentioned three strategies. First, adapting to regulatory technology, like tech. We are using artificial intelligence, AI, to monitor and analyze changes in regulations so that you can quickly adjust. Next, the frequently politics of compliance. Utilize audit research to pinpoint areas in need of development and strengthen the overall compliance posture. Next, platforms for regulatory intelligence make proactive adjustments to compliance plans in light of changing the regulatory landscape by utilizing real-time updates. So I would like to call Jason to continue.
We are going to look the module landscape of finance. So the continuous learning of the key of people success. So the finance world is driven by the constant technology innovation on the rise of fintech startup companies. So there are so many startup companies in Lanka who integrate the powerful artificial intelligence and data tools and process of the finance life goal. So and at the unprecedented pace. So the continuous learning is a matter. The financial media have the traditionally laid on strong foundation and the core financial concept and the analytical skills. However, the digital evolution demands the broader skill set. So the continuous learning is essential in the financial management skill. So staying relevant to the landscape and enhancing performance and statistics are the key for the financial management and we succeed in the future. So in the next slide. So strategy for continuous learning and development. The financial management and world to continue the revenue level. This can be achieved through the media to education, industrial resources, and the independent learnings. Courses are available in social media, online, free and etc. So, and also central organization also providing the guidelines and learning the overall employee. So such as providing the mobility, encouraging knowledge sharing, centers like money and learning and all. So rewards continue learning as well. So like I say, regarding the learning reshape knowledge, the continuous learning, the employee and financial and user forms. So here the key people financial management. So and for the financial expertise and financial management, there need to cultivate a specific skill to excel. Yeah. Here these are the key area focus. So for example, technological fluence and understand knowledge. Familiarity with the key finance technology like the relevant to the IT sector. At the same time, financial managers want to sell on fintech technology. Here, data and dependent transformation data into insight. The financial manager can leverage the data effectively, can identify the trends and the risk and optimize the financial performance, and making the data available and control their organization and market to the employees. And we more in cybersecurity. Nowadays, there are so many types of attacks and all this different. As financial institutions become the great cybersecurity is very important for it to grow. I mean, foreign countries, there are so many cyber attacks, blockchain, cyber attacks as well. So that's a good example.
Besides some of them.
That's all. Thank you for the yeah, activating for the Q&A session.
Question number 1 might be on virtually, so you can ask the question. Number 1.
Let me ask a question, right?
Yes, you can ask.
Okay. Could you explain the history of the pre-digital era and in Sri Lanka and how it developed?
I will ask them. In Lanka, I don't think the late 1980. They before until it continued developing until today. And at the milestone, I think most evolution of the digital digitalization in Sri Lanka made up to smartphone, smartphone they and other things last previous period, going pandemic period. After that pandemic period, most of the learning methods and work from home methods came to the public people. They want the modern business trade, modern industry after that period, and other recently in 2020, Central Bank of Sri Lanka they claim that the 2020 is the year of the digital transformation. The campaign was promote the digital transformation of the import. Sri Lanka was this technology going forward.
You get the answer.
Thank you.
Do you have any more questions?
Yes. Hi. The second question is from our group 1 is, so this digital era, how it influence the risk management for finance managers? I think you got that question, no?
So, then we are changes how the financial management one such thing is that there are lots of data available. So, because of it, one main disadvantage is cybersecurity attack.
Okay.
So that financial managers should be aware of how to secure their information or data that are available. And another thing, they can use the available analytical tools to use data and analyze trends that are in the market, and also success their product or service that they are marketing to this data. The financial managers can analyze. Also, when it comes to investments and borrowings, analytical tools give them while they can invest with high interest rates and borrow with low interest.
Okay.
Okay. I think all from the group number one. I have one question from you. Again, appreciate your commitment in preparing slides and preparing for these presentations like this. I believe you have learned something related to the topic, for sure. So my question is now with the digital transformation or the digital things now with the use of things like AI, robotic process, blockchain, and the digital payment system. So likewise, sort of many things now transforming to the digital percentage. So as you explained there, the role of finance manager, like integrating investment financing, digital, all the things now we can do with using the support of the AI detective things. So like that we can have some possibility to have that kind of person. So when happening things like this, what do you think about that agency problem? With this, with the transformation of the things with the digital platform and that shape, will the agency problem will exactly minimize? What sort of impact would be there on this agency problem? I think you learned that under the introduction, agency conflict between these people. So how would affect this digital transformation? Yeah, what sort of impact would be from the digital transformation on the agency conflict? What is the agency conflict? The agency problem of
is completely financial. So transaction going to be so there will be a this program because some shares may be sold those to these operators. So it's maybe
about the agency conflict. Under the introduction part, with the separation of the ownership from the control, there is a problem with all agency relationship. With the agency relationship, there will be a conflict with all agency conflict. So I'm asking that between digital transformation, using the automated thing, robotics, devices, and the AI kind of things, how this digital landscape, how will impact on this conflict? Will it be exacerbate or we can manage it? Because agency conflict is arising because you know the reason for the separation of ownership from the control. How would that affect by this? That is I'm asking. So you didn't aware about the agency problem. This is coming under the first lecture.
Yeah, the big no.
Why?
AI, they don't have the ownership. The AI, use the for so they can get the own AI for the organization. So the cybersecurity attacks are not done from their side. So
I do not agree with the answer. With the introduction of the system techniques, mechanism like this, right? So this agency conflict, we are doing auditing with the independent people, with the independent company because of this agency problem, agency conflict. Now with the introduction of the what we call that kind of a software, kind of a system, so we can enhance the integrity as well as the transparency, as well as the control. So therefore, agency conflict will be manageable, will minimize with the introduction of the things like in the digital era. So this is from the research. Right? This is from the research how this affect from the digital era and things of these interactions. So you better to be very well to shape your commitments and the contribution of the presentation. So we'll give the chat for that also. So this is final. And talk that more. So now so you will have a 10-minute break and come back. We can continue the lecture. We have to do the fiscal record. So I can give the marks if you want. But anyway, this is only for the presentation. Out of 50, another 50 marks will added for that for your report. They like it statistics. So for the presentation, group number 1, 42, group number 2, 42, group number 3, 46, group number 4, 48, group number 5, 42, group number 6, 41. All are above 40. How many can you use? Presentation day. Final day.
Hi, Miss. Oh. Excuse me, Miss.
More or less, they are. That we have. Worries, but anyway, the time management is not right. No. It's me. පොත්පත් මොනවද දෙන්නද ළමයි? මැඩම් පොත් දෙන්න ඒ ප්‍රොජෙක්ට් එකක් ගන්න කෙරුවා සෝන් නැද්ද? මැඩම් කියනවා අපි කොහොමද? මැඩම් තුන්ලා කියලා. මේක මැඩම් දැන් හැමෝටම කියන මැඩම් තුන්ලා දෙන්න. Olha, isso é só. අනිතට පිළියාව මට ඉතරක් නෙවෙයි. මෙයාට සම්බන්ධ Strawberry, Sihayani, Bakery, should I see that? More. You are being here. Ada එකේ කරපු ලේබල් එක එකට එකිනෙකට කියලා. ඒක මාර්කින් වගේ and madam even color I speak color madam can you come up like madam even oh madam और मैंने भी बता सकती है ice cream का ice cream में क्या होगा वो एक है होगा अभी अभी मैंने अभी करता था हमारे पर मैडम ना इधर कौन सी ऑनलाइन कर रहा है वो मैंने कहा ऑनलाइन करना मैंने बेटा समझे ice cream लगना देखिए मैडम unsystematic risk you can diversify the rate. Only the systematic risk is the matter. So when it's come to the investment portfolio, systematic risk you can measure related to the diversified portfolio, related to the well-diversified portfolio. So in the conceptually, when we calculate the systematic risk, we consider the market portfolio as the well-diversified portfolio. If in Sri Lankan context, our market portfolio is Colombo Stock Exchange. We have only one market portfolio. So that market portfolio consists of 298 stocks, 20 sectors. So this is the well-diversified portfolio. So systematic risk you have to measure related to this market portfolio. Now, in your portfolio, if you have only 2 stocks, like we discussed in the previous 2 weeks, this is the feasible set of portfolios that you can construct by using these 2 stocks. If you have a market portfolio or the well-diversified portfolio like market portfolio, this diagram, I'm not going to explain more deep, right? This is this diagram, you can see a shape like umbrella. This is we call feasible set of portfolio. This is more investment portfolio management. Right? Our market portfolio is the Colombo Stock Exchange. It is our market portfolio with the 298 stocks. So if you construct all possible portfolios using this 298 stocks, this is the feasible set of portfolios that you can identify. By identifying all set of portfolios, if you draw this diagram, here you can see standard deviation of the portfolio. This is the expected return of the portfolio. In a well-diversified portfolio, no unsystematic risk. No unsystematic risk. So therefore, this standard deviation represents only the systematic risk. Continue, right? In a well-diversified portfolio, no unsystematic risk. Unsystematic risk is identified away. Because of this variance covariance relationship, that unsystematic part you can avoid. So only the systematic risk is matter. So systematic risk you can measure using standard deviation of the portfolio here. If you identify all possible set of portfolios by using the market portfolio, you will end up with a diagram like this. We call this as a feasible set of portfolio. If you are specializing in finance or whatever degrees like this, under the portfolio management using the Excel, you can draw this. This is we call feasible set of portfolios. In this feasible set of portfolios, everywhere there is portfolio. This is the feasible set of portfolios. So you can see portfolios in everywhere, 100,000, 10,000. So like a large number of portfolios. On this slide also there is a portfolio. Right. You can see it is explaining here also with the stock in the whole market portfolio. The feasible set of portfolio looks like the figure like this. Theoretically, we market the feasible set of portfolios identified diagram approximately. So this feasible set of portfolios represent all portfolios that can be constructed from a given set of stocks. Here we have 298 stocks. So by considering all these 298 stocks, you can construct different portfolios. So these are the feasible set of portfolios. In this feasible set of portfolio, now you can see there are portfolios like. So portfolios lie on this line here. We identify as efficient portfolio. Now here you can see portfolio P, V, C, P, R. These are we identify identify as efficient portfolio. Now, if you take the portfolio here, this is not efficient. What is the efficient portfolio? You can see it is there. Efficient portfolio is the portfolio where it is a portfolio which will give you the maximum return at given level of risk. It is the efficient portfolio. All the portfolios which lie outside the efficient frontier, so we call this as a market line as well as efficient frontier. Don't worry about this too much, but because I want to go to the capital, that is why I am explaining this story, right? All the portfolios lie outside the efficient frontier. Now, if you look at this portfolio Q, this dot, so likewise all this portfolio A are not efficient. Why? These are inefficient portfolio. Inefficient portfolios have low return and higher risk. Now, if you take this portfolio here, this is not efficient. Why? For this level of risk, this is the risk level of this portfolio. This is the standard deviation of the portfolio. But the parameter x-axis is the standard deviation. This is return, expected return. For this risk level, now if you take this portfolio, this is the risk, portfolio risk. For this risk level, you can go to here. If you invest in this portfolio, this is the expected return. Now here, this is the expected return. For this risk level, why do you invest in this portfolio? For this level of risk, you can go to this portfolio. So this is the efficient portfolio. Portfolio C is the efficient portfolio. Why? For this level of risk, this is the maximum possible return that you can earn. Clear? So therefore, we identify this P, B, C, D, R. All the portfolios lie on this line from here to here are as the efficient portfolio. Why? For the given level of risk, this is the maximum expected return you can earn. So therefore, all the portfolios lie from here to here are efficient. Therefore, if you take a portfolio here, there are portfolios here. This is not efficient. Why? For this risk level, you can go to here. Right? So therefore, we call this as an efficient frontier. This is the feasible set of portfolios. This is Markowitz theory. Capital market theory arises. The capital market theory started with this Markowitz portfolio theory. This is feasible set of portfolios. In this feasible set of portfolio, we call this line as the efficient frontier. Efficient frontier or capital market line. All the portfolios lie on the efficient frontier are efficient. Right? So you can see this is with the risky market portfolio. This is with the risky market portfolio. This is the efficient frontier and feasible set of portfolio with the risky market portfolio. Now here we invest in 298 listed companies. These are risky investment. Okay? If you invested in the equity shares of the listed companies, it is risky now. So these are risky investment. So this feasible set of portfolios and also this efficient frontier, this is we call capital market line. Right? This is we call capital market line even from here to here. We call capital market line. Capital market line. All the portfolios lie on the capital market line are efficient. So this is if you invested on the risky market portfolio. But as the investor, you are not investing your total wealth only this risky market portfolio. Right? You may combine this risky market portfolio and the risk-free asset. These are theoretical aspects, right? Normally, investors may not invest totally on the risky market portfolio. You may combine. You may combine with the risky market portfolio. You will invest some part of your wealth on the risk-free investment in the treasury bills, in treasury bonds. So you may construct portfolio by investing risk-free investments also. right? So with the introduction of the risk-free investment for this Markowitz capital market theory, now capital market line goes like this, right? So this is only with the risky market portfolio, or this risky market portfolio with the introduction of the risk-free investment. There were risk-free investments a lot investor. So with the introduction of the risk-free investment, now your capital market line or efficient frontier goes from risk-free to market portfolio to research. This is theoretical things, right? So now this is the capital market line, or now this is the efficient frontier. So all portfolios lie on this efficient frontier or capital market line are efficient. Now, if you take the portfolio from here to here, we call lending portfolio. We call lending portfolio there are portfolios from RF to M. Right? Portfolios from here to here. The portfolios from here, RM to M, we call lending portfolios. Why? Why we call lending portfolio? Because from your wealth, some part of your wealth you are investing in market portfolio as well as from the risky investment. Now, if you take a portfolio sum here, so you may invest more on the market portfolio and risk-free rate. Weights decide the formulas. But anyway, this is you should know. Portfolios from here to here we call lending portfolio. Why? Because you are investing part of your wealth on risk-free investment as well as market portfolio. So portfolios from here to here, the main line, the main ticket in the portfolios. All are efficient. We call borrowing portfolio. Right? We call borrowing portfolio because here from here the portfolios lie from M to upwards N up to Z. We call a borrowing portfolio. Why? Your total wealth as well as borrowed money at the risk-free rate, both you are investing in the market portfolio. I think it's a bit difficult. Sometimes you may take this one, but anyway, don't worry. Now, if you take a portfolio here, this is lending portfolio. Lending portfolio means 50% of your wealth you are investing in the risky market portfolio. Say 50% of your wealth you are investing in the risk-free rate. So that is lending portfolio. Now, if you take the portfolio here, we call borrowing portfolio. Why? 1.5% of your wealth you are investing in the market portfolio, minus 0.5 you are investing in the risk-free investment. So likewise, now if you take the portfolio here, that is borrowing portfolio. Why? Not only your wealth, ACI, invest in the market portfolio. So therefore, market portfolio rate is 1.5, investment in the risk-free rate minus 0.5. So that is we call borrowing portfolio. In the method, you are a risk taker. What risk taker? Treasury bill rate එකට borrow කරලා ඔයාගාව තිබ්බ රුපියල් 100යි තව රුපියල් 50ක් borrow කරලා both you have invested on the risky market portfolio, right? So therefore portfolios from here to here we call lending borrowing portfolio. From here to here we call lending portfolio, right? So the importance of this capital market line or the efficient frontier. Now, using this capital market line or this new efficient set of portfolio, now we are going to estimate this premium. The slope of this capital market line is the premium even for systematic risk in the market portfolio. Because this is market portfolio, unsystematic risk is not there. So only the systematic risk is matter in the market portfolio. So therefore, using this capital market line, now you can estimate risk premium for the systematic risk, but only for efficient portfolio. Right? Because capital on the capital market line, there is only the efficient portfolio. The may portfolios here. There are portfolios outside this capital market line, but they are not efficient. අපි efficient frontier එකෙන් තියෙන portfolio එක invest කරන්න නැති වෙන්න පුළුවන්. අපි ගාව portfolios තියෙනවා. හැබැයි ඒක efficient නැහැ. ඒතකොට අපි efficient නැත්නම් අපි කොහොමද market risk premium එක ගන්න කියන එක systematic risk premium එක ගන්න කියන එක ඊළඟට අපි කතා කරනවා with the cap. Right. So now with the capital market line, you can estimate risk premium. So that is my point. This is what I want to show you. Now this is, you can see capital market line or the efficient frontier with the risk-free investment. So you remember the formula: investors' required rate of return is equal risk-free rate of return plus risk premium. So risk premium for bearing to bear in the systematic risk. So now, based on the capital market line, you can estimate this risk premium. But the problem is, you are estimating risk premium only for the efficient portfolios. Only for the efficient portfolios. The slope of the capital market line. This is the capital market line. Thus, describe the best price given for level, given level of risk in equilibrium, or the best price of a given level of risk in the equilibrium. So that means, in simple terms, for this level of risk, what is the premium? For this level of risk, what is the premium? So likewise, for a given level of risk, you can see in this line in the x-axis, this is risk, systematic standard deviation, systematic risk. For this risk level, what is the premium? What is the appropriate premium? So this capital market line gives you the best price or the best premium for this given level of premium. So technically, mathematically, this appropriate premium you can estimate using the slope of the capital market line. So slope of the capital market line, you know, delta y divided by delta x mathematically. So slope of the capital market line you can calculate expected return market. The difference between here. So this is expected return market minus risk-free rate for this difference. Market expected return minus risk-free rate for this difference divided by here standard deviation of the market. So then it will give you the slope of the capital market line. This is the market portfolio. This is the expected return market. This is risk-free rate for this gap. Delta gap delta y divided by delta x. So this is delta y. So this difference is the delta x. Normally it's slope formula. ERN means expected return market portfolio divided by risk-free rate. Sorry, minus risk-free rate divided by standard deviation market. Standard deviation market. So this is the slope formula. Slope of this capital market line you can calculate like this. So then you can apply this formula, risk-free rate plus how we calculate the risk premium, slope of the capital market line multiplied by standard deviation of your portfolio. Remember, when you apply the capital market line to calculate the expected return, always these portfolios are efficient. It's a capital market line based risk premium you calculate only for the efficient portfolio. Now, Right. So this is the formula. So slope of the capital market line gives you the best price for a given level of systematic risk. Suppose that you have a portfolio here. You have a portfolio here. That you have a portfolio here in the capital market line. Then your portfolio is here. In the capital market line, your portfolio is here. Is it an efficient portfolio? If your portfolio is there, is it an efficient portfolio? It's efficient portfolio. Now you want to estimate your portfolio expected return. Then we expected return based on the forecasted with the probabilities you calculated. Now using the CMA or the capital market line. So this is the best estimation because we estimate here based on the systematic risk. So you want to estimate your expected return of the portfolio. So your expected return of the portfolio you can calculate using this formula. Risk-free rate plus risk premium. So here this is risk premium. From here to here this is risk premium. How you determine the risk premium? So you should know what is the slope of this CML. Slope of this CML. එතකොට අපිට අපේ capital market එකේ CML එක ගන්නලා slope එක ගන්න පුළුවන්. Slope of the CML. So the slope of the CML gives you for the appropriate risk level what is the best price. එතකොට මේ level එකට මේ තමයි අපේ risk එක. This is our risk level. This is standard deviation. So this is our portfolio risk. So then you will get the slope of the capital market line. So this slope you have to multiply by what? Your portfolio standard deviation. Standard deviation of your portfolio. This is your portfolio. This is for the efficient portfolio. Now look at this example. For the exam, if you are given information like this, using the CML, you should be able to calculate the expected return. So you are given risk-free rate from the treasury bill or treasury bonds, risk-free rate is 10%. Market expected return. Market return is given based on what? Market return is based on what? Then we research market return market return is based on what? Our market portfolio, all share stock market portfolio, all share price index base. Market return we estimate here based on the all share price index. Right? Basically using the price differences. So that is 15%. Then standard deviation market. Market portfolio standard deviation. Right? Market portfolio standard deviation. Standard deviation so this is market portfolio standard deviation. Then using this information, you can calculate slope of the capital market line. Slope of the capital market line is equal market return minus risk-free rate divided by market standard deviation. Market risk. Market return 15%. Risk-free rate you can see 10% divided by standard deviation market portfolio. Standard deviation market portfolio. 10%. So this is the slope of the capital market line, 0.33. So this is the standard risk premium given for systematic risk in the marketplace based on the CML line. Market systematic risk ekakayak වෙනුවේ given a premium එක for the efficient portfolio. If you have an efficient portfolio. Simply that is the meaning. So slope of the CML is 0.33. Now you have a portfolio. You have an efficient portfolio with the standard deviation 12%. You have your own portfolio. It is also efficient portfolio. It's an efficient portfolio. Portfolio CML right? This portfolio is efficient. So there, it means that your portfolio on the CML. So your portfolio standard deviation, you have calculated 12%. It's a portfolio systematic risk. This is an efficient portfolio. So you have only the systematic risk. So your systematic risk is 12%. So this is the premium given per unit of systematic risk in the marketplace. So then your expected return for the portfolio is equal risk-free rate plus risk premium. Risk-free rate is 10%. So you can calculate your risk premium for this risk level. May risk level premium. So this is your your portfolio standard deviation. So the risk premium is 12 into 0.33. So then you will get 13.96. This is normally we are doing in the practically when we want to estimate the expected return for the efficient portfolio. If you have efficient portfolio, if you have a portfolio on the efficient frontier, your portfolio expected return based on the CML line, you can estimate like this. For the exam, if you are given market return, market portfolio standard deviation, risk-free rate, so you can, and also if you are given, if you have an efficient portfolio, so then you should be able to calculate your portfolio expected return based on the slope of the CML line, like this. Are you clear this? Maybe deep mathematical part, but anyway, this is the story. So for your our market portfolio, you can identify efficient frontier. All the portfolios lying on the efficient frontier are efficient. So the efficient portfolio expected return a risk level expected return you can estimate using capital market line based on the slope of the capital market line. But the problem with the CML capital market line, it gives the expected return and the risk relationship only for efficient portfolio. CML, this is the CML for the efficient frontier. The problem with the CML is it gives the expected return and the risk or the standard deviation only for efficient portfolio. Problem is that. Now suppose that you have a portfolio, it is there. Efficient portfolios invest portfolio market risk-free invest so our portfolio is somewhere here. It is a diversified portfolio, but not efficient. Not efficient. Efficient na make out in load. Your portfolio should be on the capital market line, but this portfolio is diversified. Make a diversified portfolio, but not fully efficient. So then, problem with the CML capital market line. So it gives the expected return and the risk relationship only for the efficient portfolio. Now the problem is if you have a portfolio here below this CML line, so then how to estimate your expected return? Right? The problem is that it only gives the efficient portfolio. So therefore, inefficient portfolios for individual stocks, how to estimate the risk premium? That is the problem with the Markowitz capital market theory. The maker Markowitz. Method capital market theory is 1955, 58 around theory. Theory problem invest portfolios, but are not in the efficient frontier. We have individual stocks investment. These are also not in the frontier. So then, how to estimate your risk premium? So now, CAPM is coming. Capital asset pricing model is coming. So because of this problem, in 1965, 67, 64, like Sharpe, Lincoln, and Moisen, these are empirical developments. So they introduced a model we call capital asset pricing model. Even today, in the companies to estimate the cost of capital to see whether particular stock is overvalued or undervalued. So likewise for the pricing valuation, still we are using this theory. CAPM model, capital asset pricing model is abbreviated format we call CAPM. So what is this CAPM? So CAPM gives capital asset pricing model, or the CAPM gives is a model provides required rate of return at the beta relationship for all assets or any portfolio, either efficient or not. So there is a new variable that is we call beta coefficient. Beta coefficient. So with the CAPM, now in here, this is CML, capital market line. So there will be thousands of lines there below the capital market line for the securities, for the inefficient portfolios. We call them as the SML, security market line. This is CAPM, capital market line. There are lines here. So we call them security market line. So with the CAPM, we identify this security market line. So based on this SML, security market line, we estimate required rate of return for individual assets or portfolio of assets, either efficient or not. You can apply this model to estimate the required rate of return. What is the logic here? I will explain in very simple format. Now this is our market portfolio. We have 298 stocks. Right? We have 298 stocks. So based on this market portfolio, you can identify efficient frontier, efficient portfolios, everything you can identify. Right? So now suppose there is a company, say Sampat Bank, it is there. Sampat Bank PLC is there, one of the company. So then, according to this CAPM, it says that systematic risk. You know what is systematic risk? Systematic risk, you have to measure this particular company's contribution to this total risk. If I further elaborate, now this is our market portfolio. If you calculate the standard deviation of the market portfolio, it reflects only the systematic risk. Why? Then make a market portfolio, you can make an unsystematic risk. Unsystematic risk automatically diversified because this is a well diversified portfolio, our market portfolio. If a company stock is there in a well diversified portfolio, this particular company systematic risk you can measure by this particular company's contribution to this total risk. That is the argument. What is the argument? Right? You get my point. Then may market portfolio. Is there a tablet? Have you students something? Single theory method. You can understand? Then may have a market portfolio. Either may market portfolio return based on the all share pricing. Risk standard deviation calculate the same formula. May market portfolio risk it implies only the systematic risk. Right? Unsystematic risk it is diversified. Then a company maybe Sampat Bank PLC theory. You want to measure what is the systematic risk of this particular company, this particular stock. We do have a portfolio by investing in the 20 companies. But it is not an efficient portfolio. I see a what you want to calculate required rate of return for this portfolio. So this CAPM provides the solution. The CAPM make company may total risk market return market portfolio standard deviation for so that is this company's systematic risk. May portfolio standard deviation may portfolio confusion. This is very more technical things, right? So on that way, you can measure the systematic risk for this particular company or particular portfolio. To measure this one, we are using a variable that is we call beta. Beta coefficient. If you look at the formula for calculation the beta, you can realize this. Beta of the, say, Sampath Bank PLC is equal covariance between Sampath Bank stock returns with the market portfolio divided by variance of the market. Variance of the market portfolio. This is the beta. Right? I think it is there. Beta of the company X, company Y, or beta of the portfolio even. You can calculate covariance of this particular company's return with the market portfolio return divided by variance of the market. So this will give you the beta. The one covariance එක Sampath Bank stock returns market එකත් එක්ක කොහොමද covary වෙන්නේ? You know covariance අපි calculate කරන්නේ. That is this particular company's return covariance with the market return, market portfolio return divided by variance of the market. So it gives you the beta. You can see here, since the stock's beta measures its contribution to the risk of portfolio. So this is the risk of the market portfolio. Beta is the correct measure of the risk. According to the captain, make a pitu 300 ගානක theory එක captain. Right? So capital asset pricing model, I think it's freely downloadable listing. It is a theory, empirical development. This is the way of calculating systematic risk. In addition to measuring the stock contribution of this to a portfolio, whether a portfolio can a market portfolio, right? This is market portfolio. We can also measure the stock's volatility relative to the market. This is important. Then beta එකෙන් අපිට measure කරන්න පුළුවන් සම්පත් බැංකුව market එකේ risk එකට කොච්චරක් contribute කරනවා. ඒක තමයි යාගේ systematic risk එක. ඒකම if you know the beta company I am coming to the interpretation. If you know the beta, you can identify volatility of this particular company related to the market. ඒක තමයි යාගේ systematic risk එක. Systematic risk එක කියන්නේ diversify කරන්න බැරි ප්‍රමාණය. So that is you have to measure related to the well diversified portfolio. The මොකක්ද අපි ගන්න well diversified portfolio එක market portfolio. Theoretically, in the market portfolio, beta always equal to 1. Market portfolio එකේ beta එක. දැන් අපේ Colombo stock market එකේ beta එක. Theoretically, always equal to 1. Make a weighted average beta. Right. So likewise, beta you can calculate. So you will get beta like this by using that formula. Covariance between particular company with the market portfolio divided by the variance of the market. Then while a stock market website here, you can download the beta coefficient for the companies. I think in the data library still it is there. When I am doing my PhDs, it was there. I get from the data library, stock market. But anyway, you can calculate this formula as well as you can use the regression. Market return, if you regress with the stock return, the slope is the beta. Empirically, අපි එහෙම beta estimate කරන්නේ. Market return එකයි stock එකේ return එකයි අපි regression line එකක් ඇන්දොත් ඒකේ slope එක beta. Empirically, you can calculate. So beta can be a number like this: 0.5, 1, 1.52, 0, 2, and also it can be negative. Beta can be negative. Now say beta is 0.5. What is the interpretation? Suppose particular company beta is 0.5. So it means that this particular company's systematic risk compared to the market portfolio, it is halfly risk as the market. That always in the market portfolio, beta risk is equal to 1. If we market compare the beta define kara. Sampath Bank PLC beta coefficient is 0.5. ඒ කියන්නේ market risk එක වාගේ මේ company එකේ systematic risk එක තියෙන භාගයයි කියන එක. So further if I elaborate, now suppose like this. If it is 0.5, like this. If market return if increased by 1% in a particular time, this particular company's stock return is increasing by 5%. If market return decreased by 1%, this particular company stock return is decreasing by 5% because beta is 0.5. Market risk is half. 0.5 can bargain. Again, market එක යම් කිසි වෙලාවක 10%කින් වැටුණොත් මේ කම්පැනි එක වැටෙන්නේ 5%. ඒතර යාගේ සිස්ටමැටික් රිස්ක් එක මාකට් එකට කම්පෙයාර් ටු ද 50. 50.5 and 50. 10කින් ගියොත් අරයා 5කින් වැඩි වෙනවා. 10කින් ඩවුන් වුණොත් කම්පැනි එක වැටෙන්නේ half. So likewise, suppose beta is equal to 1. Company beta so it means that this particular company systematic risk is same as the market risk. If I further elaborate, if market return in a particular time, if it is increased by 1%, this particular company return also increasing by 2%. If market return decreased by 1%, this particular company return also decreasing by 1%. Market risk is same as the systematic risk is same as the market. Say greater than 1.5. Beta is 1.5. Very high systematic risk. Market risk risk company. So systematic risk is very high. Aggressive stock here. They are very aggressive. Why? If market return drop by 1%, a particular company is decreasing by more than that 1.5. So you know that risk return relationship risk return risk return risk risk only the systematic risk. Economic crisis market return so that is high risk. Beta is 1.5. It is greater than the market portfolio. Stock excess return varies more than proportionally with the excess return of the market. Market return so that is risky. High systematic risk. If it is say like 0.5, say 2, it can be 2 even. 2 can be systematic risk. If beta is 2, what you can say about the systematic risk? Very high, very high. 1.5 high, the high systematic risk. Because market down, so that is high systematic risk. It can be minus even. Beta can be minus. Possible. Now you can see companies like in the mining. Then may market substitute market invest market down real estate mining companies gold mining and a company beta make up negative. So when the market is say minus 3% B, if market return decreased by say 1%, that particular company what happens? Increase by how much? So mining or the negative beta also possible. Market inverse practically market market economy. Either market company performance market another positive relationship. But anyway, there are certain investment like mining and a kind of industries. So it goes against the market. So then beta is beta is negative. Right. So likewise, you should be able to explain the beta. So this is the CAPM model. If you go to the CAPM model, this is the CAPM model, capital asset pricing model. So based on the capital asset pricing model, again, we are on the same formula. Required rate of return is equal risk-free rate plus risk premium. Right? So according to the CAPM, you can apply this capital asset pricing model for individual stocks, for the portfolio of stocks, portfolio efficient for any portfolio, you can apply the CAPM. So according to the CAPM, required rate of return is equal risk-free rate plus risk premium. Risk premium calculate you can see here, this part we call market risk premium. Market return, required rate of return in the market portfolio minus risk-free rate. Make what a second. Market return minus risk-free rate. That is we call market risk premium. අපි සිංහලෙන් කියන වෙළඳපොළ අවදානම් අධිකය. ඒ කියන්නේ වෙළඳපොලේ systematic risk එකකයක් වෙනුවෙන් කරන ගැනීම. In the very simple format, this is market risk premium. This is the premium given for unit of systematic risk in the market. So then market risk premium, you have multiplied by your company beta, your portfolio beta. So then it will give you your risk premium. So your required rate of return is equal risk-free rate plus risk premium according to the cap rate. So the slope of this SML line is the beta coefficient. So this is what the cap rate. What I expect from you, you should be able to apply a question like this. Suppose you are given expected return on treasury securities 8%. Expected return on the market portfolio, is 13%. Beta of the sage PLC 1.3. Find the required rate of return for the sage PLC based on the CAPM. Then you have to apply this SML line, capital asset pricing model. What you can say about the sage PLC is systematic risk. This company systematic risk. What you can say about this company systematic risk? Beta is 1.3. Why? Systematic risk is high. How do you